Well, good afternoon. Thank you so much for joining us. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm very excited to be joined by one of my longtime friends in the industry, as well as a REIT industry slash Fish, the rock band veteran, my friend Matt Werner, the portfolio manager at Chilton Capital Management. For those that don't know, make sure my screen is still being shared. Share. There we go. I just wanted to highlight before we get into it, just to kind of show you guys a little bit of the history of Chilton. I'll have Matt go into it as well. But I have covered Chilton going back to my trading days of two iterations back in 2000, my days on the desk at Green Street. And the reason why I highlight this is Chilton's always publishing their monthly performance. It goes back many, many years. The takeaway here, if you look at it, and Matt can correct me if I'm wrong, but 1 month, 3 month, year to date, 1 year, 3 year, 7 year, 10 year, you guys have outperformed the RMS and the VNQ REIT ETF. Is that correct?
Yeah, and since inception too.
And since inception, correct. And the chart that I'm showing you here is net of fees. Another interesting chart, and they publish this stuff every single month in their monthly commentary, and I highly recommend you start following Chilton's monthly commentary. It's a great shareholder letter. It basically talks about what $1 million would have done in an investment over the course of the time using the recommendations. Again, in a perfect world, in the 20-year picture here, you would have taken that $1 million, and with the Chilton model, it would be at 5.2 million. But I also shared here their portfolio allocation by property type, just showing how diversified their portfolio holdings are, and we'll get into it. This highlights the performance disclosure about various AUM levels, fee, performance results, standard deviation. Again, this is all the information that you can get from Chilton Capital. And then obviously from the compliance perspective, attached is the Chilton Capital disclosures page and the fund legalese. We'll leave this up here for a couple of seconds for people to absorb. As I mentioned, I'm very excited to be joined by Matt Werner. Matt is the portfolio manager and the lead portfolio manager of the Chilton Capital REIT management team. He works under founder Bruce Garrison, and Matt will tell you about Bruce and his history. But, Matt's frontline, meeting with management teams, doing the PM type stuff, interacting with clients, building out the portfolio. He is a member, he is a CFA charter holder. He's been quoted in numerous publications. I always like seeing Matt quoted in the Journal or on Bloomberg. Lives in Houston. As I mentioned, also, coaches soccer and baseball, golf, skis, hikes. Hopefully here we'll get to do that again this year. And then, as I mentioned, he is known to go see a Fish concert from time to time. So, Matt, let's jump into it. Let's have some fun. Tell me about the history. For those that don't know, tell us about the history of Chilton.
So Chilton's been around. Thanks, David, for that intro. And, it's been great. It's weird being called a veteran in anything, but have been around the REIT industry now for going on 15 plus years. And I've been a Fish fan for longer than that, but it's been great getting to know you over the years, and glad to do this today. And thanks everyone for joining or listening on the recorded version. Chilton's been around since 1996. It started in Houston, and we only have one office here in Houston. We've managed about $3 billion today. 27 people, and we're over here in the 610 Loop in Post Oak for anyone in Houston who wants to stop by and see where the sausage is made. Bruce and I, and I'll get into a little bit of Bruce's history, but Bruce and I have been working together since 2009 at a prior firm called Salient Partners. We moved over to Chilton in 2011. Chilton does have multiple strategies. So we have an equity strategy that's benchmarked to the S&P 500. Also managed fixed income strategy. And then Bruce and I and our team of 2 other analysts do the REITs, and we manage about 700 million today. That's available via separately managed accounts at most custodians and several wirehouse platforms. And again, please follow up with any questions on availability. But we have enjoyed being at Chilton and learn a lot from the other investment teams, and look forward to the next 20 years as well.
Yeah, I covered you guys back when it was Pinnacle before it was even salient from way back when. So that tells you the history. So what is the sweet sauce? We had your performance metrics that were up there. We saw the performance and how you guys have outperformed RMZ and VNQ on a historical basis. What makes you guys different from your typical institutional REIT investor? And let's talk about some of these performance track numbers, because again, you are very transparent in your monthly commentary. This is what did well for us. This isn't what did so well for us. But let's unpack some of that if you don't mind.
Yeah, I mean, I learned, and having Bruce as a mentor who's been in the industry for over 50 years, who's seen it all, and it's been great learning from him, and certainly interacting with other um, REIT management groups over the years. And there's certainly a lot of common threads between what I think a good portfolio manager and analyst can do, which includes property tours and meeting with CEOs and CFOs, and hopefully building proprietary earnings models. And so at least I would hope most teams are doing that. I think some of the things that have helped us to produce almost 300 basis points of gross outperformance annualized going on 20 years has been just our ability to focus on risk a lot more. We've protected capital in downturns much better, I think, than most of our peers. We've have been a heavy focus on the balance sheet, what's going on not just the left side of the balance sheet, but the right side, and when that can be important is when you have downturns, and when investors tend to focus on that. So we like to focus on that throughout the cycle, and focus on risk adjusted returns, and taking a longer time horizon. In this kind of fast paced world, there's a lot of people are worried about 1 quarter of earnings, or what should the value be tomorrow, and let's go long short on some spread. We're much more longer term focused, have 2-year price targets that look out to not just where things are today, but where the puck is going. And then we're kind of at 700 million sounds like a lot. A lot of our peers have in the multi-billions and tens of billions. They can't be as nimble as we can, so it means we can flip from overweights to underweights really quickly. And then additionally, we can make a small to mid cap REIT, with a market cap of 4 billion or 5 billion or below. We can make that a significant part of our portfolio, and we've had a lot of success in some of these smaller names that some of our peers can't really play in, or if they do, it can't be a very significant piece of their portfolio due to liquidity concerns.
Talk about mitigating risk. Does that also mean like sitting on cash? If things get volatile, you guys will sit on cash? Or as PMs and REIT managers, your job is not to sit on cash, that you're always fully invested?
That's a good question. We have used cash in the past, and it is part of our investment policy that we have the ability to do so. And we did that to some success in 2008, and even 2007 as things started to turn. But since then, I think our primary classification is, I think, as a bottom-up manager. That's what we're good at, is finding good ideas on an individual company level, and trying to make a macro call on just what's happening to the entire sector, and going to cash and missing out on 1/4 or 2 quarters of dividends, and predicting what's going to happen with interest rates, which tends to have a high correlation with public REITs, is very difficult. What we saw in 2006 and 2007 was declining fundamentals at a time of very high valuations. So risk level was high and projected returns were low. And we haven't really seen that since. Obviously, we've had our share of pullbacks since then, but none to where it was just a obvious. Not it wasn't obvious to everyone at the time, but it wasn't anything that was screaming, hey, REITs are super overvalued and the numbers don't look good. And so if we did see that again, we wouldn't be shy about having 5-10+% cash for a month or 2 or 3. But we have not felt the need to do that, because we've seen how things can flip pretty quickly, and the volatility has been high, and missing out I'm sure people have seen those stats. If you miss, the top X amount of days for performance in a year or over a long time period, you miss a significant move. And I could tell you, with the volatility we had in April with the tariffs, we had several clients wanting to go to cash on the pullback and miss some of the, one of the biggest days we've ever had, and other clients had the opposite reaction, which is it's always interesting to say, who's got that appetite for when things when the going gets tough. So
To go
cash is not a big part of our.
to go back to your 06, 07 comment, though, I mean, REITs today are a completely different industry than it was back in 06, 07. This goes back to when Green Street put out their herd on the beach, urging REITs to go to sub 50% leverage, back when the REITs were much more levered up way back when, if you recall. And the REITs were pushing back at Green Street saying, that's not going to happen. We can't go to sub 50% leverage. That's crazy. And here we are now, because as I like to say, these REITs have learned their lessons from previous cycles. What worked in the past, what didn't work. So when we're faced with that same obstacle in the future, we know what to do because we've already been down this road. And so we tend to learn from past, let's say, mistakes or success stories to make sure we put that game plan forward. For those that don't know, though, Chilton, long only or long short?
Long only.
Preferreds or any other alternatives, or is it straight equities?
Oh, we do have an income strategy that utilizes preferreds, but it's not the most scalable. The REIT preferred market is not very liquid, so it's not a main focus of our marketing efforts. But for anyone who's on the call or listens and is interested, we'd be happy to discuss it. It's I personally believe that the common will have better long-term total returns than preferreds, but I understand that there are specific client desires for current income, and you can get pretty good yields over 7% today in REIT preferreds with not too much, certainly not much balance sheet risk, but those are do have pretty high correlations to interest rates.
It is why we have a slice in our fund. Obviously, our high dividend yield index does have a slice of preferreds just for that reason. So let's get a little more into it. What sectors do you guys like, and what sectors don't you like, and maybe a little bit of reason about both, about why?
We really like healthcare today, and this is a kind of a good example of our nimbleness. Going back to the beginning of 2020, we had 0% healthcare. Now it is our largest sector, and just one we really like because it's benefiting from demographics of people aging that need care from doctors and surgeries and behavioral health centers, and also places to live with that has care as well. So also really like the risks there are really they're pretty immune to some of the exogenous risks that happen in the economy. And so it's just been a great place to be, and we've done quite well with our senior housing play, which, by the way, was something we were very negative on going into 2020 when the supply and demand was completely off, and now where there was too much supply, not enough demand, and now there's a lot of demand and not enough supply. And so those are the kind of things that we like to look for.
Let's go a little bit further into it. Not Welltower, because everybody loves Welltower, and they're the largest cap name that's out there, one of the largest cap names. You briefly mentioned earlier small and mid cap focus, again, because you guys like some of the small and mid cap names. So for somebody who's watching this, what would be a good example of a smaller mid cap healthcare REIT name that you guys are looking at, or that you guys own potentially?
Yeah, we are actually underweight Welltower relative to the benchmark because of valuation concerns, but we still like the story, and so don't want to miss out on all of it. But I think a good example of our strategy is there was an IPO of a company called American Healthcare REIT in February of last year. The ticker is AHR. It was a non-traded REIT that was invested in a lot of the same things that Welltower owned, and unfortunately for their non-traded REIT investors, took on too much leverage, was not well managed, wasn't the right kind of leverage, and they were forced to go public at a price that was about 75% below what their investors had originally put in, which was painful, I'm sure, for them. And as public investors, we got the benefit of getting in at that lower price. And it was a pretty off the radar name. We sent one of our analysts to go to a property tour. There was a couple other people on it. And when the first 13 Fs came out, we were the only REIT dedicated manager that was in the top 30 holders. So, we were a little, I guess, contrarian out on a limb there. And fast forward, now it's been a year and 3 months or so since the IPO. The stock is in the mid 30s. It's almost more than tripled. And I think it's just a good example where they're benefiting from the same, supply demand dynamics that Welltower is, but we got in at a much lower valuation. The name was a little off the radar, had a little hair on it, was previously mismanaged, had a little too much leverage, but still putting up great numbers because of what was going on in just that sector environment.
Yeah, I was just pulling up a chart here to put it on top of the picture here, just so you can kind of see. This is the performance of AHR since it's gone public for the REIT players. I mean, it's been one heck of a ride, as you can imagine. Well, talk about the stuff that you like. What's the sector that's kind of out of favor with you guys right now?
Well, we don't own anything in malls or lodging. Just think that there's too much risk there for what you're paying for in the valuation. I think one I would like to highlight would be industrial. Going into this year, we were pretty underweight industrial, not because of some fundamental issue with the sector. Just the expectations seemed really high, and there was very high valuations. Had been kind of considered a nice place to hide in the recent volatility in 2024. And we just couldn't justify some of the valuations. And going forward, I think the numbers are going to be good, just not good enough to justify some of the valuations. So now that they have been squarely in the focus of investors, given the tariffs or potential for more tariffs or less, just volatility around tariff headlines, industrial has gotten hit even more. Now we're getting a little more interested in the sector and believe that the valuations are getting more reasonable, but it's still one we are underweight. And maybe I think that was probably a pretty out of consensus pick by us going into 2025.
And if somebody was looking at industrial names right now, what might be a name or two to put on their watch list?
Well, we've decided to take a little risk there. We are pretty heavy in Rexford. The ticker's REXR. This is a company we've owned in the past. We sold it in the 60s per share when it was trading at over 50 times cash flow, or AFFO was the number that we use in the industry. Just again, thought the valuation was too high. Now you have the opportunity to buy Rexford in the low 30s at a multiple in the teens. And so if you're just have any conviction that this company could just stabilize at some of the growth numbers they put out and trade back just even at 20 times earnings, you can make a lot of money with this name. And they've got a great balance sheet, only 10% leverage, and a pretty decent yield on a very low payout ratio. So it is 100% Southern California, which is probably considered the worst industrial market in the country, and certainly most vulnerable to changes in supply chains on shipments from or to China. But it's still got very high occupancy and pretty good mark to market on rents when the leases on their tenants come due.
Good stuff there. All right. You mentioned tariffs. What does Chilton think about tariffs and the impact on the potential impact of the REIT sector?
Yeah, I mean, I think I've mentioned, I don't think I need to go too much more into the intra-sector relationships there. I think about REITs as being a potential beneficiary of asset allocators out there that are thinking about where to put money if there is volatility around tariffs, and that REITs have very little to no impact on their earnings, at least especially their current earnings from tariffs. They aren't in the business of importing anything. and really, we came out of 1Q earnings season, and there was no changes to guidance based on tariffs. And I think that's a contrast to a lot of other just traditional equity companies. And then you could even take it further. So the other direct impact that tariffs would have, other than changing supply chains, is the cost of construction. So tariffs on construction goods, or
Lumber, steel.
exactly, will increase or will continue to increase the cost of construction, which makes it more difficult to justify new construction, which lowers supply, which makes, again, that supply demand dynamic look more favorable as we look out the next year or two or three.
So I was at the NYU REIT Symposium a few weeks ago, and I had a chance to talk to Owen Thomas, the CEO of Boston Properties, Leslie Hill, CEO of RLJ, Mark Perrell, CEO of Equity Res, and a bunch of these other guys, Sam Landy at UMH. And a lot of them said basically exactly what you just said right now. Look, we're a landlord. We are not subject to tariffs. Now, our tenant might be impacted by what's going on in the tariffs, but my job is to lease up this office property. Because I'm a landlord, I'm not impacted by tariffs directly. But as you just said, if I'm developing a new property, we might see some impact on that as far as rising lumber and steel costs and construction costs. But in chatting with one CEO, I'm not going to say who it was, and he's like, David, look at it from 3 days. Liberation Day -1, Liberation Day +1. Here's what did not change over those 3 days. My earnings, my AFFO, my FFO did not change over those 3 days. My dividend has not changed over those 3 days, but my stock price is down 30% over those 3 days. What does that person know selling my stock down 30% that I don't, as the CEO, know about from where I sit? The word uncertainty has been kicked around so much by these executives, especially in the first quarter earnings calls, that a lot of these guys are, as I like to say, putting on the blinders. My job is to focus on fundamentals. How do I grow my revenues, cut my expenses, and maximize my NOI, or my net income? At that point, they're not letting tariffs kind of dictate where the world goes. They're focusing, again, on leasing, improving the portfolio, and growing. So I think your comments echo a lot of what the other REIT guys are saying. But with earnings now moving into the rearview mirror, what was your guys' takeaway from first quarter earnings? And maybe what did you kind of glean for the rest of this year looking ahead?
Yeah, our forecast for this year was plus 10 to 15% total returns for REITs. I think that was actually pretty conservative. We've started off pretty hot in January, February, and then pulled back since then. And I came away from 1Q earnings with a conviction in that plus 10 to 15%. I think that REITs should be in an environment where when there is uncertainty in other sectors, the certainty that you can get from REIT earnings and these bulletproof balance sheets and their ability to have access to capital should mean they should trade at a premium. Our 10 to 15% total return assumes REITs trade at a 0% premium to NAV. Now, that's something that we have not been able to do on a consistent basis for a while, but it is something that if you go back more than 20 years, REITs traded at premiums to NAV for 3-4 years at a time. And I don't know if 2025 will be the year or 2026, but I do think that a lot of the factors that helped REITs to trade at a premium back then are present today. And so, we don't even assume that happening, and you can still get to plus 10 to 15% total returns.
So on the screen here, again, do you see the RMZ price chart on the screen here? This highlights the performance of the REITs year to date. And we're basically back to where we were pre-tariff cuts were announced here just back in April. We've got some room to get back towards our February highs when we were kicking off the year this year. But obviously, again, if you're a technical guy, if you're a technician, it seems like based off this chart that we are working our way back towards where we were. The reason why I point this out, again, is as you just highlighted, looking at the earnings stream of some of these guys and where that puck is going, we have seen REITs raising their dividends. We've seen some guys raising their guidance. And we published a note not too long ago here at Hoya that basically looks at the S&P performance versus the REIT performance. And right now, it seems like the S&P is outperforming the REITs by like 35 to 40%, which that performance is almost like unprecedented. It's always been a much smaller gap, if anything. So something has to give. Either the S&P guys have to sell off, the REITs have to rally, or it's some combination of both. And I think part of that overhang, as you just highlighted, is how many REITs are trading at discounts to NAV right now. We're so yield sensitive. The 10 years of 4.428 right now on my screen. And so if we can get that 10-year yield to come in, REITs yields rise, right? So at the end of the day, again, we want to see that gap kind of push the other way, but something does have to give here. So again, with all the stuff that's out there, one thing we've noticed is that the capital raising window is wide open. As you and I talked about recently, I think we've seen 6 or 7 REITs just in the past 2 weeks alone raise close to $4 billion of new capital. We know what the rate is. We know what's open at the lending window. You're not really seeing equity issuances. You might see some ATMs or a couple of forward deals. You're seeing more REITs buying back their stocks right now because of what we've been talking about here. But what do you guys think about as far as cap raising looking out towards the rest of the year? Could we see some M&A activity? What about more IPOs? Do you think that we're going to see some IPOs in the current environment coming this year?
Yeah, I mean, a lot of that is contingent upon REITs trading at a premium. So, when I think about the different tools that a CFO has or a board that's, overseeing some of the capital allocation decisions, when they don't trade at a premium to NAV, they do kind of have one hand tied behind their back. They're forced to use debt or sell properties or pursue joint ventures or other people's capital to execute on a game plan for acquisitions or earnings growth or buying back stock. And the debt markets are wide open, as you mentioned, and I think REITs are in a great spot relative to the private market in their ability to issue unsecured, some at spreads that are less than 100 basis points, which, your typical private market secured mortgage is going to be closer to 150 or 200 basis points over, or even higher, depending on the size of the borrower and credit quality. But I think that if we do see NAV premiums in across the board or in just several sectors, you'll start to see more M&A. You'll start to see more IPOs. There was a recent IPO this year of SmartStop Self Storage, one that we participated in, that's done quite well. The biggest IPO ever was last year for a company called Lineage Logistics, which is in the cold storage sector. And so, I mean, I think that there are situations where you have private companies that are of good quality that maybe are reaching the point where they need that access to unsecured capital and some public equity access, the ability to issue an ATM or an overnight offering is attractive, but it's not to the point where you're seeing it in mass, and it's very difficult to predict when these things will happen. M&A, if you are trading at a discount and someone that you want to buy is trading at a bigger discount, there is some times you can do a stock for stock transaction and make the numbers work, but usually, the target on that acquisition is going to want something higher. They want to tell their investors that they got something above NAV. So, I'm not expecting anything to heat up in the near term, but I do have the philosophy that REITs are in this environment where they should be trading at premiums. They should be able to go and issue equity and take out a big portfolio of private properties of an owner that is saddled with too many debt maturities but we can't predict it because the REITs are dependent on fund flows, and we're just not in an environment where REITs are in favor yet, at least.
Okay. So what about the other side of the coin? A lot of people cite this great note that you guys published a couple of times over now, looking at what's going on in the world of private REITs with like B REITs and S REIT valuation. As a side note, I'm sure you saw Starwood announced this week that they're bringing on Nora Creedon, who was a very well-known REIT figure from Goldman Sachs, to now be the new president at Starwood REIT, which I thought was very, very interesting. But separately, we've had this public versus private disconnect. We saw what happened at B REIT in the past couple of years as far as gaining redemptions, the fee collection stream, all this great stuff. And by the way, this is not a knock on B REIT, because I'm sure as heck never going to bet against Steve Schwartzman and John Gray personally, but we do see that B REIT kind of overhangs the sector. And so, you guys have published some very timely research looking at B REIT. What can you share with us about that?
Yeah, I mean, I admire their marketing ability and their ability to raise capital, and certainly that's not a knock on them. And they were able to raise, $50+ billion to invest at a time when interest rates were at or near zero, and they were promising investors a nice yield over 5%, and that was attractive. And they sent out an army of salesmen to go and find people that that fit. Unfortunately for them and for the investors, I don't want to say unfortunately for them because they're making money hand over fist off these things, but they ended up raising the most capital in 2021 and deploying it at the end of 2021 and early 22, which happens to be right before interest rates spiked in the quickest we've seen in 100 years. And unfortunately, no matter how great those properties are and what the cash flow growth has been, when you buy things at a 3 or 4% cap rate, and the cap rate goes to 6 or even 5.5, it's a really big move. And when you finance it with 60 or 70% leverage, that's almost 100% loss of equity capital. Now, they don't want to show that because they have the ability to publish their own NAV on a monthly or quarterly basis. In this case, they do it monthly. And they have yet to really significantly mark down their portfolios. Today, the implied cap rate on B REIT is close to 4%, versus the implied cap rate for public REITs at 6%. I would imagine that's a pretty difficult fundraising environment to go and convince someone to buy something for 50% higher price, that also promises no liquidity if you want to get out. And by the way, you're going to pay higher fees and your dividends getting paid to you back with your own money. Now, they don't tell you that when you sign the papers, and we're doing our best to make sure that people who read our research or our white papers, are fully aware of the differences between public and private. But when I talk about the attributes of REITs with the low leverage and the growing dividends, the payout ratio of public REITs today are 72 or 74%. I calculated B REIT's payout ratio. I think it was over 400%.
Wow.
So, there's just and the leverage is 60% versus public REITs at 30, so double the leverage. It's a difficult environment for them to have a proposition of we're going to be able to go and make money for their investors. And they've secured $4.5 billion from University of California Investments, and promising them an 11.25% return and that was over a 5-year period, and they're about 2 years into it, and they've produced a total return, I think, of 1%. And so to meet that threshold, I think they would have to annualize over 15% for the next few years, which great. I hope that they do it. But if they analyze at 15%, you better bet that public REITs are going to do better than that. So I really like our positioning, and I do hope that investors in these non-trader REITs understand a little bit more about what they own, and if they want to get out, that they have the ability to do so. But that's not always the case.
And Matt, just so you can remind folks that are watching this, whether live or on the recording here, when did you guys publish that first B REIT note, and when did you guys publish the update note so they can pull that down from the live?
The first one I think was April 2023, and it's called I think it's called like our arbitrage between public and private. And then And then the update was, I think, April 2025, and it's called Turning Up the Heat on BREIT. So those can all be found at chiltonreit.com.
Highly recommend anybody watching this to go check that publication out because it's just a fantastic read. All right. You talked about earlier where the puck is going. So we always, as REIT folks, always are trying to figure out where's that puck going. So what do you guys think about when it comes to demographics and migration pattern changes?
Yeah, I mentioned the demographics for seniors and healthcare and why we like that sector. The other one would be migration patterns. And so, as far as I know, we're the only public REIT manager in Houston, and we've had a great insight into what it's like to be in a Sunbelt market with good job growth and population growth. And it's one we've been very bullish on, not just Houston, but just the Sun Belt in general, low tax states with good employment growth. And so we've had an overweight to the Sun Belt markets for quite a long time. And, it's a difficult wave to fight when you have declining population growth. And so we've just been making sure we've been cautious of some of those gateway markets that like California that had out migration in as a result of COVID or just higher tax rates, getting pinched by inflation and people moving out of them. And you can be right on valuation, but if there's less people to go to the store or less people ordering stuff online or less people to go to the office, you could be in the best property and it's going to make it difficult to get that growth that you're looking for. So we do really like the Sun Belt, and you could apply that across pretty much all the property types. And I don't really see that changing too soon, although New York has certainly bounced back pretty significantly in the past, call it year and a half. Somewhat to our surprise, but I think we're going to get into some recent initiations, but we've recently increased our exposure to that market as a result of some of the data we've been seeing.
What about something like Chicago or Milwaukee, where you hear that the Midwest, those apartment markets are booming right now? I mean, think about how far back you and I go here, and we've never talked about Chicagoland being a hot apartment market. So again, that tide is turning, obviously.
Yeah, it's the Midwest has never been a huge market in the REITs, and so if you do want to play that, it's not as easy as some of the other regions. And I we have not felt that conviction to go into some of those markets as much as just the numbers just don't seem to be there in terms of the population growth. Denver.
So what you're saying is you're not backing up the Brinks truck on Center Space right now.
No, we've been meeting with them at NAREIT, and we've sent an analyst to Minneapolis to tour their assets. We've really taken a hard look at that one, and we'll continue to test our thesis, and so that's just part of our process.
Matt, what do you think are the pros and cons of REIT investing? Are there any? I mean, we talked about the private stuff before, but besides that, are there any other risks that you'd like to highlight?
Yeah, I mean, I think the biggest risk, especially relative to private, is just that you have you have more volatility and it's more subject to capital flows. If you're an investor in a private deal and they tell you you're not going to get your money back for 8 to 10 years and you get it back and you've doubled your money, in your mind there was no volatility and it was something you weren't thinking about. But I understand that volatility is I think they call it just statement volatility. Every time you send out a statement, and a client sees that the money went up or down, even if they don't plan to pull the money out or need it for 10 years, it does, have the potential to create some sort of stress. And, as portfolio managers, we like that volatility. That gives us the ability to buy things for less than we think that it's worth. If we always had to pay exactly what they were worth, then, I don't, it'd be much more difficult to have, to add as much value as we've had over the years. And then, if you're a CEO or if you're a CFO, that, the potential, uh, to be stuck in what we call a capital box. If you're trading a perpetual discount to NAV, that's probably pretty frustrating on the public market, because there's not much you can do to control that without getting the capital flows back in. Versus if you're in the private market, as long as I guess you're willing to pay your sales guys enough to go, do enough lunches and steak dinners and breakfast donuts, supposedly you can. It seems like the least that there's been some a track record of success of capital raising. But the pros of being lower leverage, lower dividend payout ratios, ability to go in and out of sectors, and in my opinion, far outweigh the risks. And especially in a time like today where, sure, when interest rates were zero, more leverage, the better. The more risk you took, the better you did. And when it's, I can't say for sure, but it doesn't seem like interest rates are going back to zero anytime soon. In these kinds of environments, I think the public REITs are really going to be able to shine and show that, why some of those attributes are so much better and should be more attractive to your average investor. But that could be anyone from a large pension fund to just an average, high net worth investor.
And I think one thing that you haven't covered, and goes without saying, is transparency.
Right.
The fact that the public guys are so transparent, quarterly earnings, investor presentations, deal press releases, et cetera, the accessibility of the publicly traded REIT management teams, the investor relations departments, et cetera. They're always willing to talk and share the story and talk to you about what's going on. And I think that's obviously something much different that you see versus the private side, that there is no transparency.
Right.
You know, we have a high dividend yield fund that we follow here. We are monthly dividend payers. We deal with a very diverse audience here. We've got institutional guys, we've got retail guys, you've got advisors, you've got everything under the sun. But when you think of REITs, we think of dividend vehicles, dividend machines. Does Chilton take into account dividends? Does it matter to you guys at all, or is it overrated?
We are total return focused. So the way our models work, they are indifferent to dividends. Now, there is a part of capital allocation where if you're just generating a ton of free cash flow and you don't have anything to do with that, you're not going to buy back your stock, then we actually are in favor of higher dividend payout ratios. But the amount of damage that can be done by increasing dividends to try and bring in more investors, and increasing those to levels that put the dividend at risk, I think is an overly risky strategy, and one that was very popular in the 1990s. But the headaches or just reputational risks that come from having to cut the dividend can really stick in people's memories for a long time. And so, our portfolio, going back to in 2020, when, there was a big question of, can you even collect rent? There was, I think, 55 or 60 REITs that suspended their dividend. Our portfolio of 25 companies, only one company suspended the dividend, and within a year it was back to its original level. So, I think our focus on the ability to pay dividends has, and that, by the way, that was one of our best years ever relative to the index. So, I think that having a yield is good. Our yield tends to be between 50 and 100 basis points lower than the benchmark because our focus is much more on growth. I would rather have a dividend yield that's 50 basis points below the index, but it's growing at twice the growth rate of the index, than just to be higher and flat.
Good stuff there. You've talked about a couple of names here and there. Can you talk about something more recently, maybe post earnings, maybe something ahead of NAREIT? Again, without showing your hand too much, but can you maybe highlight a couple of recent trades that you guys have done?
Yeah, I mentioned increasing our exposure to New York. We've been really following that market pretty closely. we decided to initiate a position in BXP, believing that was the best risk-adjusted way to get exposure to the New York office market. It's about 30% of their portfolio. There are a couple other New York office REITs that are, 100% focused, but we didn't believe their debt and dividend metrics were aligned with, what the would create a risk-adjusted return that was attractive enough. And so, BXP is known as, probably one of the highest quality REITs of all time. Great management team, and in Boston and in Cambridge, in New York, in suburban DC. DC proper has been a pretty rough market to be in, and then they've made a couple mistakes going into the West Coast, which ultimately we'll see how they pan out. But it's just, if you believe in any sort of return to office happening on a broad basis, BXP is going to benefit, and New York is already ahead of the curve on that.
Well, look at the deal that they did in DC. If you recall, just a couple of weeks ago, they acquired a property. They're going to demolish it. They haven't even put the shovel in the ground. They basically already fully leased this new property that hasn't even started yet. So, and they also tiptoed into Seattle. One other point I'd note out with BXP, like a lot of these other office guys, imagine that Rolodex when you can call government of Singapore, Norges Bank, Canada Pension Plan, Baker, Abu Dhabi, etc., and raise sovereign wealth fund to go out and do sovereign wealth capital to go out and do this mega deal that you want to do. Those guys want to work with the best operators, the best partners, because those sovereign wealth funds have 25 to 50-year investment time horizons. They don't care about what's going on this past quarter in the US with tariffs. They're thinking about what's going to the Empire State Building going to look like 25 to 50 years from now. But again, they don't own the Empire State Building. I'm just using that as a broad example. What do you guys look for in capital allocation from REITs? And maybe more timely, what kind of conversations are you having with the companies right now?
Yeah, I mean, we've, as I mentioned, are in favor of companies that have low dividend payout ratios, which means they have hopefully a lot of free cash flow. And, I do think the job of a REIT CFO is very square. You can judge a REIT CFO very squarely on their capital allocation decisions, and that means, what kind of debt maturities and debt, when did you decide to recast your debt? Was it when interest rates were at zero, or are you forced now to refinance at a much higher rates? And what are you going to do with this free cash? Are you going to buy back shares, or in this case, we've been recommending companies to increase their dividend if they are below that call it 75% payout ratio level. We think interest rates are going to be stubbornly kind of in this 4 to 5% range, and if you have the ability to get your yield above that and show some growth, and without having too much risk by doing that, we are in favor of companies raising those dividends. There's certainly some value to accumulating cash of some war chest to be able to go out and make some, fire acquisition of somebody that's stuck, as I mentioned, on the private market. It just doesn't seem like we're there, though, in having these opportunities that look so attractive and needing a ton of cash. And I do think there was a great example last year of Cousins Properties buying this building in Austin called the Sale Building, and they did an equity offering overnight to raise a few $100 million to buy it. And this was the first time I'd seen this in a long time, but the stock actually, they raised it at a very slight discount to what their prior close was, and it closed the next day well above that number. Historically, this wasn't always the case, but really for the past 10 years, if you were going to do an equity offering, you could pretty much guarantee your stock was going to be down, and you'd have to take a pretty big discount. And so I think this shows that you don't really need to have a war chest. If you can show a good deal to the market or a good use of capital, hopefully the market will reward you with that equity capital at a nice number, and therefore your current cash flow shouldn't be needed to accumulate. And let's get those yields up to make them attractive relative to what someone can get risk-free in the money market.
Did you see that story that digital subleasing is taking some of the sublease space from Google at Sale Tower?
Oh, I did not.
Publishing
No.
the real
Hey,
deal, right? Publishing the real
okay.
deal in the past day or
Hey,
so.
that's a good example. Their headquarters was in San Francisco. Now they moved to the great state of Texas.
That's right. Jordan and Andy are very happy to be in Texas. So what's the 3 to 5 year setup look like for REITs right now in your eyes?
I think that if you can get some stability on the 10-year treasury and have some confidence that we're not going above 5 and going to be there for an extended period, that this is going to be a great time for investing in REITs. You've got very little new construction happening at a time when the economy seems to be doing pretty well. Now, if it starts to do less well, that's okay because there's this big buffer we have because of the lack of new supply. And by the way, you're starting at a uh, pretty low valuation point relative to a few years ago. You know, going into 2022, public REITs were trading at 27 times AFFO. Now we're sitting at closer to 19 or 20 times. And the growth is, if you know, we like to show, you know, year over year, same store NOI growth charts. It looks like this next quarter will probably be the trough in terms of same store NOI, and what we're going to start to see accelerating earnings for the next few years. That tends to be the best time to invest in REITs. I look back, you know, 2022, we actually had really good earnings growth, but unfortunately it was decelerating at a time when interest rates are going up. So now the starting point is completely different. We've already got interest rates high. You know, maybe there's a chance they go down, and if they do, great, we're going to do really well. But if you can have accelerating earnings growth, I think that's going to grab the attention of investors, and especially even if you're comparing it to the S&P 500 and the Mag 7. We've seen what can happen to them when, you know, when something's priced to perfection, all of a sudden they get a few chinks in the armor, and maybe the earnings growth is not going to be as great as it has been, but still good. You know, those multiples can contract really quickly, and the REITs, I think, are in a position where it could go the exact opposite direction. So next 3 to 5 years, you know, we're seeing 4 to 6% dividend growth off of 4% current yield. You know, that can get you to an 8 to 10% total return pretty easily without any change to the 10-year treasury. You know, if that 10-year goes to 4 or below, which, you know, who knows what's going to happen with that. But you know, I think that you could easily be in the low double digits and look back and say, you know, 2025 was a great time to really get interested in public REITs, especially relative to other asset classes.
All right, so you've mentioned Rexford, you've mentioned AHR, you've mentioned Smart Stop, and a couple other ones. Give us 1 or 2 more names that somebody should put on their watch list and why.
I'll give you one big sleeper, and this is one that most people, even in the REIT community, might not know about. The ticker is SILA, Sila Realty. They
Another
did
new
actually,
IPO. Interesting.
they well,
Okay.
they didn't. They did a modified Dutch auction on a direct listing in June of last year, so they didn't raise any new capital, which means they didn't get the big coverage from the sell side. They didn't have to go pay a bunch of bankers. And the market cap is actually pretty nice. It's over $1 billion. They own over $2 billion of real estate. They did
For
not.
those that don't know, what sector are they in?
This is a healthcare REIT that owns mostly freestanding behavioral health and medical office buildings that are triple net leased to pretty good credit tenants.
Do you know the geography focus off the top of your head?
They're based in Tampa, Florida, but their biggest market is in Texas, but mostly Sun Belt.
Welcome, baby. Okay,
And
good to
they did not need to raise any new capital because their debt ratio was so low. They have a net debt to EBITDA of 4. The average REIT is almost 5. They can lever up to 5.5 times, which means they can go out and buy a couple $100 million worth of properties without having to raise any new equity, which was a really great time to invest in a REIT when they can ramp up without having to raise new equity. Relative valuation is attractive. And by the way, that spread, so their incremental borrowing costs are in the mid fives, and this is not like going out and buying apartments that trade at 5 caps. They can buy stuff at 7 or 8 caps. They can make a 200 to 250 basis point spread. We believe that's going to grow earnings pretty significantly over the next few years. So and they have a nice yield, only pay out 70% of their cash flow, and the yield's over 6. So you're kind of being paid to wait. It's so off the radar. It's not a big, piece of the indexes and ETFs yet. It's not, on the radar of other institutional investors, but I think if they can execute on this acquisition story in the next couple of years, this thing could trade much, much higher.
Like it. So Matt, we're close to the end of the time here. I'd like to open it up to Mr. Werner Sr. or Larry or anybody if they have a quick question for for Matt here. Going. Matt, I want to thank you so much for taking time out of your busy schedule, especially now with earnings season moving in the rearview mirror, NAREIT on the not too distant horizon for all of us fun REIT folks. I really can't thank you enough for sharing your wisdom and knowledge with us over the past hour. And I can tell you that this audience has learned a lot from your comments. And so here's to another 25 years of great REIT investing, and really appreciate you spending time with us today. I can't thank you enough.
Thanks, Dave. Yeah, glad to be on. Thanks, everyone, for listening.
Thank you. Stay with me.
I think you need to hit stop recording.
I'm trying to. Oh, wait, maybe I need to do this. There we go.